Thank you so much, everybody, and thanks again to Senator Daschle, Tom Scully, and Dr. Reed Tuckson for the previous enlightening panel. So we now have 1 hour to fix the individual market. We have until 10:45. So we have a really terrific panel today. We're going to focus, as Marilyn said, on stabilizing the individual insurance market, what that means in the short term and in the long term. And of course, while this market covers fewer than 10% of Americans under 65, it obviously has an outsized focus in today's health policy debate. Concerns about stability have arisen, and they're interconnected with questions about affordability, subsidies, access, and incentives to be in or out of the market. Really, we have a fantastic panel, and I want to just briefly introduce them, and then we'll get into our questions. To my left is Karen Bender. She is president of Snowway Actuarial and Healthcare Consulting, and she's currently the chairperson for the Individual and Small Group Committee of the American Academy of Actuaries, among many other qualifications. If you want to know how to be an actuary, you come talk to Karen after. Welcome. We have Peter Lee to her left. He is the executive director of Covered California, the first health exchange created after enactment of the Affordable Care Act, and he previously held leadership positions in the Obama administration, working on healthcare delivery reform and quality improvement. Next, Tom Miller is a resident fellow at the American Enterprise Institute, where he studies healthcare policy, including health insurance and market-based alternatives to the Affordable Care Act. Ed Haislmaier is Senior Research Fellow in the Center for Health Policy Studies at the Heritage Foundation and has worked on a vast array of health policy issues, including alternatives to the ACA. And finally, last but not least, Chris Holt is Director of Healthcare Policy at the American Action Forum and spent almost 7 years on Capitol Hill, most recently for Senator Scott Brown. So thank you all for being here. So let me just kick off with an easy question. Is the individual market in crisis? Why or why not? And how do we get here? And I'll ask anyone who wants to start it off to jump right in.
I guess I'll assert something. As in 2017, there's certain pockets that had limited choice in the country. With some of the announcements that have already occurred with Humana pulling out and with WellCare pulling out, it makes 2018 potentially more problematic.
Let me build on that. We may be in crisis, and we'll know in the next 6 weeks. And I think Sarah's...
That's a good way. Yeah, that's a good way of putting it.
Across the nation, there's 400 health plans making decisions on do they participate or not next year, and if they do they participate by raising rates 10% or 50%? And that's all in play on 3 big decisions that are really before the Trump administration and Congress right now. And I think the prior panel was great. Insurers are about spreading individual risk, but they aren't about insuring about political uncertainty and risk. And if they've got big uncertainty, they're going to step back and not play. They aren't going to be rolling the dice. So they're looking for the signals that they have enough certainty to play next year.
And also, the insurers need to be able to make money. They can't consistently lose money, and for the statistics are pretty well in for the first 3 years of Obamacare, and in the individual market, a lot of insurance companies have lost a lot of money in the individual market. Not all. Not all.
A lot of plans made a lot of money, but the place where I'd agree strongly with this is that plans that 4 years ago were ready to lose some money on a long-term bet are not willing to lose anything next year, because the year after next, the year after that are even more uncertain. So I think that every plan for 2018 is saying, if I don't see a way to make money this year, I'm leaving the market. And one other thing I just note is that plans are doing just fine on Medicare and fine on their employer business, fine on Medicaid, which is 90% of their business. So a plan can walk away from the individual market and do just fine. And if they're going to lose money in the individual market, they'll walk. And if we give them, we policymakers give them that uncertainty, they're going to walk, and it could be a really bad year.
Well, that might be part of the triage for the emergency room. Look, if you want a crisis, you're going to have to do better than this. What we have is a chronic condition. We may have brain-dead health policy, but it doesn't mean that it's physically dead. We move the rubble around and we move on to something else. It's been going on for a long period of time. What the language of crisis usually is used to do is to encourage worse policy, saying, well, we couldn't do any worse than this next policy.
I come back to the point I'm sort of a one-note Johnny on, which is that there are really two markets that we're talking about here. One is the subsidized market in the exchange. The other is the unsubsidized market, the vast majority of which is outside of the exchange. And the part that is inside the exchange really, should be counted with that. The exchanges, the subsidized market is continuing its path to what I saw years ago as its natural equilibrium state. And its natural equilibrium state is basically a giant high-risk pool for a Medicaid-like population with maybe one or two insurers covering it in a state, maybe more than that in a bigger state like Texas or California or Florida or New York. And so we're seeing that very clearly. Will that continue? To Peter's point, yeah, I think it's quite possible that will continue. Is that a catastrophe? No, because basically, if it gets to that point, you can just recognize it for what it is and bid it out to somebody. And as long as you're willing to subsidize it enough, they'll take the whole package, just like you do with Medicaid managed care. The other market is the non-subsidized individual market, and that's the one I worry about, and that's the one and that's the one where we are in the early but disturbing phase of a crisis. And by that, I would give the example of Wellmark in South Dakota and Iowa, which was never on the exchange, even though they're the Blue Cross carrier, even though they're the biggest carrier in those two states. To Peter's point, they don't need that individual market business. They were never on the exchanges, yet the spillover effect is such that as of last fall, they announced, and they were advertising, by the way, that, hey, you can come buy ACA compliant coverage off the exchange from us and it's just as good or better. They've now changed that. So as of this year, they're out of ACA compliant coverage off the exchange. They'll still continue grandfathered plans. They're out in South Dakota. They went into the exchange this year in Iowa, but only in 40 of the 99 counties, only where they had a link up, a subsidiary with the local hospital monopoly. They've even now pulled out of that. That was the announcement the other day that they're pulling out in Iowa as well. That's what worries me.
See, if I can build on that, I think they are two markets, but the whole point of what the ACA tried to do is say make them one market, and by subsidizing lower income, healthy people, it benefits people that aren't subsidized.
Right, and that was the theory.
That's the theory, and in many places it's worked, and in many it has. So California, the average rate increase over the last 4 years has been 7%. That's far lower than double-digit increases, and the main beneficiaries of that are not the subsidized people, because they get a subsidy. It's the 1 million people that aren't subsidized.
And that's where you have to look through and say, to the extent did that work, and it may have for other reasons, worked in California, but it clearly seems to have failed in a lot of other places. And actually, in a lot of other places, the solution is to unwind that and to separate those markets.
The ACA.
Otherwise, you have a situation where the anchor is pulling the boat under, like I said, in South Dakota or Iowa.
Right. So let me give Chris a chance to jump in if he
Sorry.
wants to, and then I want to follow up a little bit on this inside-outside issue. So Chris.
So Peter beat me to it, but I was going to say, I think going back to what Peter said, it's not just that we'll find out in 6 weeks if we have a crisis. I think there are areas of the country where we have real problems right now. We know that. There are additional areas where we could have more problems, and that Peter would tell you there are areas of the country that are doing very well. So I think we need to keep that in mind when we're thinking about the individual market. It's different depending on where you are. And then I was also just building on what Ed was saying. I mean, this is really one market, and this is going to become an issue when we talk about how to deal with a lack of offering in the exchange. And one of the proposals that have been put out there is to allow subsidies to go to non-exchange compliant plans, or non-exchange plans that are still QHPs. In some cases, they aren't going to be there. So that's an issue that we haven't really figured out how to address yet.
So let me just, so a point of clarification. So the ACA required that the inside and outside the exchange plans be counted as a single risk pool. But the rules of the road for the plans inside and outside of the exchanges? Did the states make those decisions, the exchanges? In California, you had a very specific rule about plans being sold inside and outside the exchange being similar. So talk about that.
Identical.
Identical. And how did that affect the adverse selection or not?
I'd ask some of the others to speak to other states, but there's federal rules that plans on exchanges are generally offering their same products, same prices off exchange. But they can offer a whole range of other products off exchange, but they're still with the standard actuarial value rules, they're still with the standard essential health benefit rules, et cetera. And so the markets, the common risk pool markets that are pooled on and off exchange are offering broadly with the same package. Now in California, it's the exact same product, exact same price, exact same networks, and that's what's covering 95% of Californians, whether they get subsidies or not. And so that's the broad mix.
And I would simply note that DC and Vermont eliminated off-exchange sales, so you can't buy off the exchange.
The ACA theory is premised on the old advice of President Eisenhower, which is if you can't solve a problem, enlarge it. The problem is they just created a bigger problem.
But you have a valid point, and the differences between any benefits that you can sell on and off the exchanges are minimal, very, very minimal. I would say initially the more distinguishing factor was maybe off exchange you had more wider networks being available than you did on exchange. The on exchange maybe focused more on narrow networks. I'm not sure if that's the case anymore because as experiences has gone out, a lot of the companies have sort of streamlined their benefit portfolio.
And importantly, there's a lot of discussion and argument about which of the 3 R's, risk corridors, reinsurance, and risk adjustment made sense. Risk adjustment is across the entire market, on and off exchange, subsidized, unsubsidized. And if people off exchange are getting healthy people, they're contributing, whether it's on or off exchange, to plans that are getting an unhealthy mix. I think that's a healthy thing.
Except when risk adjustment doesn't work as designed, as we've seen happen.
Well,
yeah, but Tom, the notes of, here's the reality we are today, is there's a lot of really healthy discussions about how to change things for 2 years out, whatever. We're in a reality where there's 20 million Americans in the individual market, of which 30% may have no insurance. And and this isn't a created crisis. This is health plans making individual decisions in a bunch of the country of whether or not to play or not. And this, I didn't create this crisis.
There's only one thing we do well, which is kick the can down the road, move the cost to someone else. We're not solving anything.
But
No, I think we've got real solutions, Tom, and it's good sound bites of kicking the can down the road, but the people we're kicking down the road are 4 million Americans that you're taking their insurance away from. That's not a can I want to kick. That sounds like a good
that was set in
football.
motion several years ago by other people.
So let me jump in here, and so I should have sat between those two.
this is like,
If you tie people to the railroad tracks and call them hostages, I suppose you can get your money.
All right. So let's just backtrack for a second. The individual, so again, we heard Senator Daschle talk about this collage, right, of healthcare that we have in this country. And again, the individual market, it's always been the trickiest market to fix. The employer market, pretty stable. We talked about Medicare, Medicaid, pretty stable in terms of the actual provision of coverage. So, what were the problems that the ACA was trying to fix, in terms of access, in terms of cost, affordability, so that's the first question, is what are the problems we're trying to solve, and then did they solve them, how well did they solve them, and then what do we need to do from here?
Yeah, and this gets back to the point that I've made all along. In fact, I was making these points before the ACA, which is that there were issues in the individual market that needed to be addressed. My criticism is that what they did was instead of using a scalpel, they used a sledgehammer. And so, and in the process made things worse. So if you go back to HIPAA and the portability rules were good and have worked for group-to-group portability. They were not so good for group-to-individual portability, but at least there was something there. That needed to be improved. Then where they were lacking was the lack of what we called individual-to-individual portability. And that's where I started working on this, actually here in DC with the then commissioner when the GW Health Plan went away. And people who were self-employed and bought that for years and years were now being treated as if they had just come in off the street and had no prior coverage, and now they were older and sicker. And that's the wrong, I mean, aside from it not being fair, you're not putting the right incentives there if somebody who's done the right thing can now be treated as if they had never had insurance. So that was what needed to be fixed, but you had a template. You had HIPAA, with some tweaks you could have extended it, and that would have addressed some of the biggest problems. What they did was, one, they just took a sledgehammer to it and said no pre-X under any circumstances, and thus lost the benefits of continuous coverage requirements and needed to come up with some other way, and that's where the mandates on the individual and the subsidies came in to get people to buy coverage. So that was a mistake. And then they decided to load onto this market, because it's a small market, a lot of weight that it couldn't bear. We were now going to make this small market the vehicle for covering people with subsidies, and we're going to regulate it and turn it from being a financial service product for self-employed middle-class people into a social welfare program for low-income people. And that was the thing. And that's the problem with linking the two markets together. How do you get out of the benefit mandates and all the other stuff that made it a social welfare program for lower income people and give those middle class self-employed people back what they wanted, which is basically a financial service product that doesn't cost them an arm and a leg?
So let me push on that a little bit. So, I mean, when you say financial product, what
They
do
want,
you,
they
what
want
do you mean by that?
protection. You don't have to cover everything through insurance. You don't have to have low copays and deductibles. I just want something, I'm self-employed, I'm middle income, I want something that in case I get hit by a bus, it covers me, that kind of thing.
Well, actually, people would like more if someone else would pay for it.
Well, yeah, but the illustration I have also on this is if you take two people who are in their 20s and have low incomes, and one has low income because they're middle class and they're in graduate school, they come from middle class, and the other has low income because they come from a poor family and they're, maybe working part-time at minimum wage. The first group, I get these all the time, the parents saying, look, I just want to make sure my kid in grad school has some basic catastrophic coverage in case something happens. It's not a question of can they afford to go to the doctor. If they need to go to the doctor, they'll go to the doctor. If I need to, I'll pay for it. The kid from the poor background doesn't have that. So if you design the whole thing around the one group and not the other, they're really two different groups with two different needs.
The unique feature in the individual market pre-ACA, and sometimes we forget about this, is that unlike any of the other markets, the individual is paying 100% of the premium and 100% of the cost sharing, whatever cost sharing you have. So prior to the ACA, I remember this statistic, the average actuarial value purchased in the individual market was about 50%. It varied, again, it varied dramatically from state to state and all that, but it made sense because these are people who, they're paying both sides. It's not like in your employer-sponsored insurance when the employer is paying either 70 to 80% of the premium and you're paying the 20%, but then you have all the cost sharing. Here, you're paying the whole thing. So people elected to have lower cost policies with higher cost sharing because you're paying it either way.
And the point I would simply make is for that 55% of the individual market that's not subsidized today, there's about 8 million subsidized in the exchange and there's 10 million outside non-subsidized. For that 10 million that's not subsidized, none of that has changed except their premiums have gone through the roof.
Well, and they're not, let's go back to, yes, what were the problems being addressed? To my mind, there was 3 problems that were trying to be addressed is, number one, affordability. For the people in the individual market, they get no financial help, so all they could afford was really cheap products. Everyone else in America, and we may disagree with it, get federal tax support to buy health care. You have employer-based coverage, 30% is covered by federal tax dollars. So this one slice got no help, so it's affordability. Number 2, the issues around excluding people who had prior health problems. How you address it, you can fix HIPAA, but people with prior conditions were getting excluded from coverage. The third problem, and it comes back to we as wonks, and I mean this as a compliment, talk about 50% AV, but that 50% AV meant people were buying products that weren't covering a whole bunch of stuff.
True.
And many times they were surprised. They had products that didn't cover cancer, that had exclusions for hospital, that had a lifetime cap of 100,000. I mean, these are the extremes, but the ACA tried to address that by saying, let's have people understand what they're buying. Now, we can say that let the market determine that.
No,
but those were three problems that the ACA tried to address. And then we can argue how they addressed them. But those were, people were getting bankrupt who had coverage because the coverage didn't cover a lot of the stuff they got sick for. And so that was part of what the ACA tried to address.
There are two other problems you left out. The very high loading costs, the nature of the market, most of that was marketing expense as opposed to profits, and that's
And
just the
underwriting.
nature of the individual market. No, not even underwriting, it was really marketing if you want to
Right.
parse through the figures. And the other problem was a majority at that time wanted to take more political control over the healthcare system. And this was the route to leverage these other problems into accomplishing that.
Yeah, back though, and this is where again, it's a question of degrees. It's not so much binary, but Peter pointed out, that people didn't know what was in it. There's a difference between providing transparency. So, for example, if you say you have to tell people what the actuarial value is, if you say you have to tell people what the loss ratio is, if you say you have to tell people what the fuel economy is on the car, that's different than saying, okay, and now we're going to have a minimum for each of those things. And that's so. For just as you distorted the automobile market and killed off the station wagon and brought in the SUV because of the fuel economy rules, which didn't apply to trucks. So if you put the same thing on a truck chassis, you distorted you're distorting the market by saying, well, there's a minimum AV that you must meet. Which made it impossible, for example, for expatriate plans.
Let me also assert one other thing. I don't have the exact number of states. It might have been 35 or 38. Did have high-risk pools for those that could not pass health underwriting. The problem, in my opinion, and this is just my opinion, I'm not representing any organization here, is that was the funding for those high-risk pools. And because of there wasn't any external funding, so they became very, very expensive, and a lot of times there wasn't any funding to help people with premium support for them. So there was access. Then there were several states where you had that the Blue Cross Blue Shield plan was the carrier of last resort. So there were ways for people that had high-risk conditions to get insurance, but it was an affordability and a funding issue.
And pre-ACA, I was working with states, like Massachusetts and Utah on this, and when you took those things, you say, well, how could you improve that? And one of the recommendations is to say, well, instead of segregating people, give them the HIPAA kind of rules in the individual market, and then instead of a separate high-risk pool, have a risk transfer pool, but apply it beyond the individual market to the whole commercial market.
So let's talk about this issue of risk, because we've talked about access for healthy people. We've heard kind of the arguments that we should take away regulations, make it easier for younger, healthier people to buy into the pool. But then the question is, what does that do? Are we just shifting more costs to sicker people and people with chronic conditions, et cetera? And so how do we create a stable marketplace that creates affordability for people who have both, who are both healthy and just, maybe they do just want a product that helps them in case they break their leg skiing. But the people who have serious chronic illnesses, of which, there are many. We've seen public health statistics that, life expectancy is even decreasing across the country. So what is the balance, and how do you do that?
The economics are you can transfer and pool similar risks. The politics are we don't want to do that, and we like to hide the other costs under a different bushel. The main way to bring that down is some type of external funding. If you simply transfer those costs across the individual insurance market, you still got the same problem. The people who can't afford policies just have their premiums go up as well. Now, the halfway step, which is the reinsurance under ACA, is to put a tax on everybody who's covered. And states have done this mostly as their main funding source for high-risk pools. But the better approach is to dive into into broader general revenue in a way in which you're using the larger tax base, which is both more progressive and widely distributed, than trying to load that onto the premium costs. We're reluctant to do that politically because it's too transparent.
I'm reluctant to do that for policy reasons too, Tom.
I just want to take an opportunity to.
No.
Let's let Peter.
Well, I just want to take an opportunity to join arms with Tom. Just totally agree, because you know you sit between us. You don't always sit between us. But I mean, it's absolutely right. Is that in the individual market, it is a somewhat sicker pool than the employer market. People retire early, et cetera. And what do you do about that? There's two major vehicles talked about. One is set up high-risk pools, segregate them, and fund them separately. The other is reinsurance to spread, lowering the cost for everybody. And I agree with the partial measure, but it actually worked really well in the first few years of the Affordable Care Act. And I would note that the American Health Care Act proposed a $15 billion a year fund for 18 and 19 to do just that, to stabilize the market. But it is taking money from someone else to lower the cost for everybody. And who do you take it from? That's the political issue. But to stabilize the market, that's exactly what you need to do.
The problem with most of these reinsurance proposals is the reason they want them to be invisible is they don't want to actually see what the costs are. And the other problem is they tend to do it ex post rather than ex ante. So you're not getting real reinsurance, which is when you go to a private reinsurer, it gets priced, and you actually pay a premium for it in order to handle that extra risk and volatility. Instead, it's just another way to try to spread this across other people who don't know what's going on.
The place where I may disagree, and I'd ask the actuary to come in, when it being priced for. I mean, in California, we sit down with our health plans every year as they're developing rates, and we knew exactly what reinsurance was worth in 2014, 15, and 16. And if there was a $15 billion pool, that would be worth next year 15% coming off premium. Because plans price for it, because it's covering certain people with certain risk and what it costs. And so you can price for it, and is it visible where it's coming from?
I think Tom's point was pricing in the sense of a classic private reinsurance contract, as opposed to pricing in the value
One
of the
prices
subsidy.
the risk, the other prices the result.
The value of the subsidy, yeah. My disagreement on that, or my concern on this, is that it becomes a giant game of tag, and you've now tagged, or you've now set up the government/taxpayers as it. And so it creates incentives for carriers to shift costs onto there. And it's, well, I know, but I'm just saying it raises some issues, because at some point you have the potential where as the cost grows, as the public cost grows, for the response to be, okay, tell you what, we're not going to let you just submit any and every claim. We're going to control the price, or we're going to decide whether this is a legitimate service or stuff like that. And so you've got a whole set of issues with public dollars. Look, the answer broadly is yes, you broaden this. So there's two ways to broaden this. One is if you had given, instead of a very narrow and very substantial tax benefit, which is what the ACA did, it gave it to a very narrow slice of the population. It was quite substantial. In fact, for most single people, the value of the ACA tax credits went to zero at about 250% of poverty. So it was really between 100 and 250% of poverty. Very narrow slice of the population, and very substantial amounts. Instead of doing that, do less and spread it over a larger population. If you had just given everybody sort of like through the Republican proposal, a basic tax credit, that would have addressed some of the issue. The other thing is, and this was the work I was doing pre-ACA, is to say, look, if you adopt these kinds of HIPAA rules in the individual market, you will have some costly effects. So for example, the big one, and you've seen this in the ACA, is now individual market coverage becomes preferable to COBRA coverage. And so you will have a selection effect. The answer to that is your risk pooling needs to encompass not just the individual, but the commercial, at least the commercial employer group market. And I would do it on the back end with a retrospective adjustment to really focus on, did anybody get an outside of the norm distribution of risk?
The wider the rug, the more we can put under it.
Well, yeah, the obstacle to that would be, folding in the self-insured employer market, which is a federal law obstacle. If you were to fold them in, they would have to, anybody you bring in to pay for it has to have the same rights to cede risks into it as well.
If you want to lower, though, the cost for the individual market, or I shouldn't say the cost, lower the premiums, because there's a difference between
Yes,
costs,
yes.
healthcare costs and premiums. You're absolutely right that it has to, that funding has to come from external of the individual market.
That's Alaska. They used external state money in the
Yeah, because otherwise, if you're just pooling among even if you do it nationally, you're just trading dollars, the cost for the whole pool will not be lower. If you're just,
It's just not a big enough pool of people.
So it's not big enough, so,
And the other thing,
not a
I'm sorry to
We
interrupt,
don't need a pool, we need an ocean.
but the other thing that we have discovered, and I think
Great
none
line.
of us sort of expect, we're seeing a lot of really high claims, much higher than we anticipated in this individual pool, much higher than I've seen in group policies. Now, obviously,
What reform might have caused that to happen?
well, one of it was the elimination of their lifetime maximum, because we didn't see that before, and there's probably other factors, but I'm not going to try and guess it. But I mean, this pool is sicker than we
now.
thought it was going to be.
Yeah. I mean, the other thing.
More billable.
Well, yeah, that's the other part.
so
The-
go ahead, but.
Yeah, because and this is the problem, is there were these other dynamic effects where you allowed people, by doing the wrong things or by not being as careful, you now create a worse situation where people can jump in and out of the market. That's a big problem. Whereas if you had adopted the HIPAA rules, you could have prevented that sort of behavior. So, that's a big driver of costs. And then you also have this situation where you've actually had a migration of people who had coverage elsewhere but were high cost into this subset of the market from elsewhere. Such as,
So let me jump
Oh,
in there, because I mean, are we essentially just playing a big game of hot potato with people who are really sick and have high cost, high need, high cost, and how do we address that? Because if as Senator Daschle, I believe, earlier said, most people can't even afford a $400 unexpected medical expense. I mean, certainly they couldn't afford a $2 million, claim. So how do we get to
The important thing is it's a small number of people, and it's absolutely the case that because of the removal of lifetime caps, there are some multi-million-dollar claims bigger than in the past. But the vast majority of people that get coverage across every marketplace are not using healthcare that much. They're not that different from the bell curve distribution you get in employer-based markets. And one of the things we need to make sure is that we get and keep healthy people in.
Because we want to get money out of them, even though they're not getting anything for it.
No, what I mean, they'd get nothing for it. Insurance is about covering uncertain things that may happen in the future. And if people don't have it, we're going to go back to having the number one thing for personal bankruptcies being healthcare.
Are those uncertainties for lower cost conditions that you're talking about?
So let's talk about the uncertainties for the lower cost conditions. I mean, so we've heard, arguments that the deductibles are too high. People can't go and they can't access primary care. They can't access the things that, should be at the bottom of that pyramid. And there have been analogies made to, you don't buy insurance for your car's oil change. You buy insurance for the car crash. But is health insurance different? And Peter, in California, you created standardized benefit plans that did not create an access barrier to some of those preventive services.
I think
So is that what we need to do?
There's a reasonable policy argument that insurance shouldn't be about insuring things like preventive care. And I'll get into that argument. That's a reasonable one. But the argument around deductibles, to me, is a hooey argument. So you don't need to have a deductible between you and your doctor. Even at a silver plan, which, yes, it's got a $2,300 deductible, but in California, we priced it so no outpatient services are subject to the deductible. So whenever you hear someone say high deductible, the first question you got to ask is, what is subject to the deductible? Every health plan can design a silver product where you have no outpatient care, drugs, tests, specialty visits, primary care. And in California, our bronze plan, which has a much higher deductible, you get 4 office visits a year not subject to a deductible. And the issue is, and you can argue saying you don't want people to go to the doctor, it's a choice. I want people to see their primary care doc. I want people to get actively treated regularly so they avoid more expensive care. And if you have a big deductible in between someone and getting their care, they are not going to get it. And I really want to challenge everyone, whenever you say deductible, ask what is subject to the deductible. No insurance plan at 60% and above needs to have everything subject to the deductible. 70% no outpatient care needs to be subject to deductible. Now, I'll note in the right question, there are winners and losers. There are a small number of people that get hospital care that will pay marginally more. But the reality is, you show up in a hospital, you're going to hit your maximum out of pocket for that year no matter what. So on the margins, I don't care that
But
much.
you're talking about where you move the donut hole around, and then by the time you're finished, the donut hole is closed, and you're just having illusory question.
So let me
But
bring
you-
this back
Tommy,
to.
Wait, this is where you took the sound bites of donut holes. I'm talking about 2.5 million Californians that don't have a deductible between them and their doctor. That's not a donut hole.
But see,
That's people getting access to doctors.
Peter, I'm sitting here listening to this, and and Sarah, when you guys were sort of having a brainstorming session, we had the doctor from Q-Liance there, and here you have direct primary care where you go in and it's $99 a month, okay, and it's retainer medicine. There's no deductible because there's no fee for service.
Not insurance.
And it's not insurance, no. But what it is where is it written that you have to run primary care through insurance? I mean, see, that's the thing. I'm looking for these innovations where you get out of this box. So one of the things they do, and it is allowed under the ACA, but nobody's really beyond them has developed it, is to say, look, we're going to have primary care paid for on a retainer basis, just flat out. It's patient self-capitation, really. The old HMO model was you pay the HMO and then they capitate to the primary care doc. This is the patient self-capitating, and the insurance covers the non-primary care stuff. It covers the specialty care, the hospital care, et cetera. So these models are out there and they can work. It's a totally different way of doing it.
But I think that the need for innovation in benefit design, absolutely. And I'll give you one example.
I just want to make sure. I just want to make sure that in setting all these rules, because you're concerned about, can people pay their deductibles, that you don't inadvertently create a barrier
And
to
I
benefit
think
design.
there is a barrier for an ACA for what you just described. I think now you have to cover a minimum of some outpatient, and so I wouldn't be able to, as an insurer, really, what I would only be offering the services would be the hospital services
Right.
or those services
And the-
that weren't
and the
covered by
specialists.
this. And I'm not sure if that would.
Well, and see, that's the problem when
Yeah.
you start saying, well, then you have to match this essential benefit.
then
you
how
have
do
to
I-
have this preventive services.
And
no
how do I
copays.
verify that this individual really did go and buy or enroll in this primary services that you're
Right.
talking about? I have no way of verifying that. So then you'd
But
have
no
some
sure
that'll
to.
just buy.
I mean, there's no need
Maybe
for
there's
the
nothing
insurer
wrong
to
with
do it.
that. I don't know.
So let's bring this back.
Can I ask Peter a question real
Yeah,
quick?
go ahead.
So when you talked about how your deductible works, where does the deductible hit, to Tom's point?
Nowhere.
What issue?
Nowhere.
We just want to keep moving until we don't find it.
In the California plans, where is it that I, as an enrollee,
It
hits?
basically, you hit your deductible applies when you go to the hospital.
Okay.
And so basically, it actually parallels largely your out-of-pocket maximum. And so it does hit some people, but it's the 7% that go to the hospital, whatever. And so but those people, again, are largely protected from the catastrophic by their maximum out-of-pocket cap.
But the other thing we have to remember is, now, I don't have the statistic maybe exactly right, but so humor me a bit. 5% of the population accounts for 50% of the total cost, and maybe it used to be like 15% accounted for 85%. So it's really the people who are driving the cost. They're really sick people, but they're a small percentage of the people that everyone else is
But that's a great, I want those 95% that aren't blowing through the cost to get the right care at the right time and not have disincentives. I want to come back to Ed's note about needing innovations. I mean, one of the things that's talked about a lot is the benefits of health spending accounts. Put it with the consumer. I mean, we're going to be looking at, in California for 2019, funding health spending accounts in bronze with cost-sharing reduction funding, assuming cost-sharing reduction exists. But the idea of actually giving low-income people a spending account, if they don't have the money, it's meaningless. But are there innovations we need? Absolutely. Are there ways to give consumers better incentives and tools to be in control of their dollars? Absolutely. But let's not have them be the footballs we're playing with.
So I want to get to the question of cost-sharing subsidies, because we've talked a lot about affordability. We've talked about deductibles, but for all those people under 250% of the federal poverty level, the CSRs have been an important affordability tool to the point where, there's a lot of concern of what happens if those go away. So I want to talk about those and then maybe ask another couple questions before we give our audience an opportunity to ask some questions. So Karen, do you want to start us off? What is the effect if the CSRs go away? What's going to happen, and what do you think needs to happen soon?
We need to know. Okay, I'm an actuary, so we're pricing right now as we speak for these policies. And if the cost sharing reduction subsidies or those payments are not going to be made to the insurers, we have to build that into our premiums right now as we speak, because the insurance companies do not have the margins to absorb this loss of revenue. And when the ACA first came about, it was our understanding that these were going to be paid by the federal government, an external source, another external source, and we priced our products accordingly. But now, if we have to continue to pay these benefits without any external funding source, we have to increase our premiums. And that's just to give you an idea. And then there's different ways of increasing them. Do we increase them throughout the whole pool, spread across the whole pool? And that could result in, I've seen some rough figures, anywhere from 7% to 12% increase right then and there across the whole pool, might be a little higher in some areas. Or is it just going to be in the silver plan? And not to get too wonky, as you're saying, but in the silver plan, that would mean that the silver plan rates, and I've seen estimates, are going to go up 15% to, in some cases, more than 20%. That's just that's before any other adjustment. That's before a trend, before adjustment for what's going on in the risk pool, aging, yada, yada, yada. And it would also mean that the silver plan would probably be higher cost than the gold plan. For those that are on subsidies, premium subsidies, it probably won't have too much of an impact, but for the 40% that are not receiving premium subsidies, how you price this makes a big difference. Whether you go, because all of a sudden, if you spread it across the whole thing, the bronze plan, all the plans are going to go up. So even those that are not getting any benefit from it will have to pay it. So whenever you raise rates, if you were going to say, how do we get a better pool? Low rates get better pools. Simple as that. The lower the rate that you can have while still be meeting your costs. That's the key. You need to have lower rates. This is going to push the rates up. I would expect to have some adverse selection as a result.
So can I build on that? Because I think that's and even Senator Daschle is brilliant, but there's some confusion, is that the cost sharing reduction subsidy will be in place in 2018 for plans that stay in the market. It is baked into the law. The question is, how is it funded? And that's what you're saying. So it's either going to be funded directly by the federal government, by a check written, or it's going to be funded by the federal government by paying more premium tax credit. Because premiums go up 17% at silver, and the premium tax credit goes up. So let's be really clear as a federal policymakers, the decision to not directly fund the cost sharing reduction subsidy will cost the federal budget about 30% more, about $2 billion more to fund the same thing. But not funding it will mean some plans will say, this is yet an additional uncertainty for me for pricing. Maybe this means I don't play at all. But to cover it, you've got to add 17%. And that's more uncertain on the off exchange, adds half the people that don't get subsidies. If that adds a factor, it means health plans have more uncertainty to deal with. It's just bad math. I just don't get it, not funding it directly.
There are a couple of other factors we're sliding over when we talk about this, which is give me the money right away and just close your eyes. It's a crisis. First, the subsidies were illegal. Small detail, actually a court decision. Well, I hate to mention that, but they weren't appropriated by Congress. Yeah. Now, the Congress should put up or shut up. Yep. They can try to hold on to their constitutional point and say, now we've decided to appropriate it. That's a political decision which this Congress is probably not capable of doing. Or it could change those cost-sharing subsidies in a different manner. Again, the problem is, how do you legislate in the current environment? Maybe they shouldn't be structured the way they are. The other issue that Karen was talking about in terms of how is this spread in terms of the cost, if you start loading these costs onto other parts of the market, you're going to lose people.
Yeah.
And so those calculations are more dynamic. It's not just, we'll just stick the cost over here and everybody will just pay it. You'll end up with fewer people going into those plans.
Sarah, can I simplify? I mean, because the economics are pretty simple. This is simply a backdoor premium payment, okay? So the reality is, if you have if you take a 70% actuarial value silver plan and you make it 94%, the actuarial calculation is you have to raise premium by about 30% to cover that. What they did is they said, well, we're not going to have you charge 30% higher for that variant. We're going to have you charge the old price, and we'll give you the extra 30% in the back door. So the obvious answer is you can just let them charge 30% higher for that particular variant and give them the extra 30% through the front door. In other words, and then what that really means is you're giving an extra 30% to the enrollee in subsidies to buy that plan because it's 30% higher than others. So there are ways economically to do it that are pretty
I
straightforward.
guess what I'm saying, though, we need to know now.
Oh,
Right.
yeah.
So this is an interesting conversation about what should happen or what would happen if we. But the reality, to Tom's point, is I don't see an administration that wants to continue to prosecute this. Okay, so at some point they're going to drop this case. They don't want to continue to argue
They're cross-pressured.
Yeah, but I mean, it's bad optics for them to be defending an Obamacare lawsuit, right?
Oh, yeah.
So I don't think there's a lot of desire to do that. They'll do these delays as long as they can. Yeah. There's a lot of, I think, good language from the Hill about, yes, we should appropriate this, but I don't see any way that they can do that. And the window's closed. So I mean, the reality is we're facing what Peter's talking about, which is, the premiums being adjusted.
What I think you do is you tweak it, and you tweak the law. It just simply says.
You have to be able to pass a law to do that.
Yeah, that's
right.
This is a small enough tweak you might, yeah.
No, but this is, I want to keep on coming.
law.
I want to keep on coming back. Some of the discussions we're having are great philosophical discussions, but out in the sticks, we got a 6-week timeline.
Yeah,
and that 6
running out of
weeks
time.
is when health plans are making decisions. And I just want to note is that
They're going to price for it.
No, but they will. But if they price for it, some won't price for it because some will say this gives us that additional factor of uncertainty. We just won't play. So those decisions are play or not and price for it. And I just want to, if Congress doesn't act in the next 6 weeks on this, there's going to be more counties with no health plan and a lot more counties with 30 and 40% rate increases that are going to be a problem. And the other issue, it will cost the federal government more. I mean, I just can't, I need to keep on repeating this, is that, and I understand that
How
there's
when
the
people
politics.
drop out of the market?
Yeah.
Well, then it's going to cost us more in uncompensated care because they're going to show up at hospitals and not
That's
have
actually
care
a
paid
net
for.
profit.
So I'm gonna open this up. I'm gonna open this up to the audience for questions. But while folks are getting organized, let me ask you. I mean, most people don't wake up every day and say, "Oh my God, what's going to happen with reinsurance and CSR?"
They don't?
Babies. I don't know. Maybe.
Sadly, I am.
You guys do.
And
Maybe
we never
everyone
talk
out
about
here
actually
does,
treating
but
people so
I
they're
think-
healthier.
I think our friends back home probably not so much, but. Right, but there are people kind of waking up every day and saying, "What is my insurance going to be affordable?" I mean, what should people be expecting, asking out of their elected officials in the immediate future to make their healthcare more affordable?
So I'm gonna echo Senator Daschle, and maybe this is my pipe dream because I live on another coast and I don't live in Washington, but it's bipartisanship. Is that in the next 6 weeks is funding CSRs on an ongoing basis, and Congress assert that you're going to appropriate, own it. But it needs to be their act to appropriate. That's number one. Number two, this administration needs to enforce the penalty. I know it sticks in the craw, but to not do that, health plans will price for it. And number three, follow the AHCA's lead, the Republican proposal to have a risk stability fund for 18. $15 billion would provide huge stability, would show that if we can't repeal and replace in 6 weeks, we at least aren't going to let things collapse. And that's a great opportunity for bipartisanship.
The AHCA did include funding for the CSRs for 18 and 19 as well.
As well, absolutely.
The problem with that, Peter, is it's a one-way bipartisanship because essentially you're asking the Republicans to give. So I think if it's really going to be bipartisan, the flip side of that is the Democrats have to give on this as well. They have to recognize this was a failure. They've got to de-link the other markets. They've got to remove the restrictions on
And
the
6 weeks.
unsubsidized.
Yeah, but
six.
Well, but that's your problem, because
Right.
that's not bipartisanship, that's capitulation.
We have
and I don't see that
we
politically
have a 2-week
happening.
recess, and then we have to fund the government, which isn't going to sort of elicit a lot of bipartisanship feeling anyway. And so, I mean, the things that are coming up now, just unless somehow CSR funding is put into a CR,
Which is a
which is-
distinct possibility.
that is
at
about the only
end.
way this.
I
that
think
you
that's
slip it
probably
at
the only
end, and
way
that's about the only
I
way.
return to the better definition of bipartisanship, which is when the evil party and the stupid party agree on something.
It's
bipartisan,
probably-
otherwise it's probably evil.
Yeah.
So we've all heard that the world is divided into people who think they're right? So, all right.
Those of you who think you're right
All
really
right,
annoy those
so
of us who
does
are.
anyone out there have a question? There's a question back there, and I'm not going to be read because I'll probably trip because I'm kind of klutz.
Have we stunned the audience into numbness?
All right, we have about 10 minutes left in the panel, so if you could keep your question brief, and my friends up here on the panel, keep your answers as brief as possible as well.
Hi, I'm Sarah Thomas with Deloitte Center for Health Solutions. So I have a lot of questions, but my first one is, if AHCA had passed and people could have subsidies on or off the exchange, what could an exchange like Cover California have done to preserve all the work it has done to create an exchange?
Well, so one, right now, I'm living in the reality of where we are, which is I'm worried about 18. So interesting theoretical question, and I'm looking forward to a lot of discussion about what's coming next, including what you buy on and off exchange. The reality is, in California, the market is working both on and off exchange because consumers know what they're getting value, and premiums are being held in check because consumers are driving prices lower by picking lower value or higher value, lower cost plans. And I think that would continue happening. And the role of an exchange in that is we show value because we help consumers shop and we help the market create better products.
Any follow-up? Any other questions? Yes, we have a couple up front. Thank you.
Hi, my name is Bobby Avery with Hurt Norton and Associates, and we represent some design firms that focus primarily on small businesses, particularly on health reimbursement accounts, where we have found that it's helped a lot of small employers to be able to offer some type of health plan. Fortunately, in the Cures legislation, we were able to get renewed standalone health reimbursement accounts. What is your opinion on expanding that? It's a bipartisan vehicle to get more folks into the marketplace.
Well, we got that in the 21st Century Cures Act, which I thought was going to be the 22nd Century Cures Act, and they got it through in December. And that's basically for the below 50 market, which was to deal with the IRS ruling, which had put a hurdle in the way. The argument is if an employer wants to provide some type of benefit to you as much as they can afford, why restrict it? We got into the desire to try to keep people only getting certain types of group coverage and the various rules that attach to that. It was a rather contorted argument. So when the HRAs first came about in 2002, 2003 by regulatory interpretation, it was seen as possibly a way to open up the market, which is basically you could use that money to go for a lot of different type of things to be more creative. And then they got hemmed in under that interpretation. So I think it would be a good thing, but it runs afoul of the schemes of folks who want to make sure that you only have certain types of configurations of coverage, which creates, that you're following these rules and everybody kind of stays inside that box.
Basically, it allows employers to define contribution employees into the individual market on a tax-favored basis, which is conceptually something that I'm in favor of. The problem is it achieved that right at the point at which the individual market became an unattractive place to go. So that's where you are today, is that as a practical matter, do you want to do that given what's going on in the individual market right now with the costs and the coverage?
But the employers would say, small employers, they're cost constrained. They can't.
Yeah, no, I
understand.
understand.
The employer mandate doesn't mean anything to them anyway.
Right.
They're exempt, and it doesn't mean a lot to a lot of other
No,
employers.
I'm just saying
Yeah.
that the
We have to have a different market.
unfortunate timing is we gave you a solution right at the point at which it no longer became a great idea.
All right, let's move on. We have time for one more question from the audience. I see a hand right there.
Hi, Heather Foster from the Association for Community Affiliated Plans. And there was a mention earlier of pulling the self-insured employer market into the risk pool, and that might help to bring down some of the costs and spread the risk. I was hoping we could talk a little bit more about that, as well as potentially, are there other products that are not in the risk pool that ought to be included in it, such as some of the grandfathered plans or COBRA or others? If we pulled more into that, might that help with prices and dropping premiums?
And let me expand. Thank you, Heather. Let me expand on the question, just because we didn't get to very much of talking about the long term, because there is so much going on in the short term. But I mean, is the individual market? I'll just ask a provocative question: is the individual market something that should be saved? Should it be expanded to create a bigger risk pool, or should it be kind of dissolved into other things like more employer coverage? I mean,
Be careful what you wish for.
Yeah.
Because you might just manage to destroy the small group market, which is a little fragile anyway. So if you take two fragile markets and merge them together, does not necessarily mean you'll get a better market. You get an even more fragile market.
Yeah, we had that issue in states where they went to group of one laws, where you effectively did that. Is it important? Yes. I mean, the problem is that the individual and small group market are, from a health insurance perspective, fairly marginal markets, as Peter pointed out. The problem economically is that they happen to cover the people who are the most dynamic part of our economy. And so that's why they're of value. They're of value not so much from healthcare as you will have a real dampening effect on job creation and economic. Well, yeah, Nancy Pelosi's street buskers, but you will have a real dampening effect on job creation if these people do not create these kinds of businesses, because one of the obstacles is, well, if I leave the big corporate, I can't get health care.
But the other thing you have to be
Or I at
careful,
least can't afford it.
in that small group market, there's really two small group markets. There's what I would call the micro market.
Yes,
Maybe that
yes.
makes sense
Yeah,
to merge the
yeah.
two. But the ones that are like, whether you define the micro market as under 10 or under 15, we don't have to decide that.
We're running out of
But that
time.
other
I
one's
wanted to
good.
get back to because I was the guy who raised the issue. I think it's fair to answer the question. The ACA effectively did that by taxing self-insured enrolled.
Belly button tax.
Right, the belly button tax, whatever you want to call it, to fund the reinsurance program. The other way that I was suggesting is that in a back-end risk transfer mechanism, what you're really trying to do is you're trying to see if any one insurer got a distribution that was significantly skewed, a risk distribution that was a claims distribution that was significantly skewed relative to the market as a whole. You could expand the market as a whole to encompass self-insured plans. If you did that, though, you would have to do it with the same terms and conditions, which means that they would benefit. So, for example, the firm of coal miners would probably get a subsidy out of that because they have a higher, more skewed.
But inevitably, they'll come under the same regulation.
All right.
Yeah.
If I could just
That's
things
right.
on that, though,
Theoretically, it works. Politically, I
Rowdy
don't
one.
think it'll happen.
I want to just agree really strongly that we do that through the HIT. That is that. But I think one of the things we always say is that the self-insured folks aren't benefiting, and they're benefiting a lot in the sense that I know the next panel is talking about Medicaid, but the incredible reduction in the uninsured is leading to huge drops in uncompensated care. And we've seen $5 billion decrease in uncompensated care. And we can argue the issues about, do hospitals really cost shift? For 10 years, I've represented large employers, and boy, do we believe there's cost shift. And so large employers are today benefiting from having more people covered. And so it's not just a one-way deal of having the HIT, the belly button tax, supporting the individual market, which is more dynamic, which needs it. There's real benefits to having everyone covered.
Sabrina, I know we're out of time. Can I just say one thing on this? One thing that a lot of people expected, certainly on the right, was that you would see employer drop, right? And if the ACA came in. And it didn't happen, and it didn't happen because the individual market was a mess. And I don't think any of these other populations are going to go willingly into the individual market right now. So whether it would be helpful or not, it becomes a political problem because...
I would simply caveat that in the data, and I published this, there is some employer dropping. What's happened is that the fully insured commercial market has dropped the commercial fully insured group market has dropped significantly. Some of that went into self-insured, some of that went into the individual market.
But the bigger lesson of the ACA is get a job, keep health insurance, or get poor. We're working on both right now.
All right, let me ask you to do in 30 seconds or less, in one word, what is the thing that needs to happen right now to stabilize this market?
Well, short term, it's predictability of CSR funding, predictability of the rules. I mean, from an actuarial perspective, to, you know, if I'm going to have to rate these plans, I need some predictability.
Yeah, I noted my big three that are short term, which is the CSR funding, long term now, the enforce the penalty, and risk stabilization funding. But I just want to know, this has been all short term. One thing we haven't gotten to talk about, which Tom Daschle queued up at the beginning, is we aren't talking about underlying costs yet. None of this discussion is about what's driving healthcare costs. None of this discussion is about why does America spend 20% more than any other country, 50% more than many, to get not as good quality. And I look forward to that next panel.
I agree with Peter on some of that, but I'll just return to the words of former New York Knicks guard Michael Ray Richardson in the 1980s during a long New York Knicks losing streak. He said, the ship is sinking. The reporter asked, how low can the ship sink? He said, the sky's the limit.
Hard to top that one, so to speak.
Tom should have gone last. I said Tom should have gone last.
Yeah, Tom always goes last. It should always go last. Look, the reality is for the 2018 plan year, aside from the cost sharing issue, which we all, cost sharing reduction subsidies, which we all agree needs to be done, and I think, per Chris, is probably going to, when all the Sturm and Drang is over, wind up as an item tucked into the omnibus or whatever they do to fund the government. Everything else is in the reg that the administration published, because the reality is nothing Congress does, even if Congress had addressed this on January 1 or January 3rd when they took office, nothing that they can do really makes a difference in 2018. It's all about 2019 and beyond. You know, what can be done is being done. That's the way to put it, I guess.
Thank you.
Yeah, I mean, looking at the 2018 market, right, what needs to be done, insurers have to have some idea of what they're going to see in 2018. And the opportunity to give them that certainty is fast closing. So, yeah, I mean, I think Congress needs to figure out a way to allocate funds for CSRs in 2018, and then, yeah, everything becomes about 2019, if there's still enough insurers participating by then.
And Sarah, I just want to say, just going back to the beginning with you and Marilyn, I think you have the makings of a reality television show. You know, policy wonk, food fight. We took a group of policy analysts, gave them a broken market, and 1 hour to fix it. Let's see the results.
Wow. Our ratings are going to be through the roof. Thank you so much to all of you.
It wasn't dull.
Thank you. No. All right. So we got a break, thank goodness. There's, I think, still some snacks downstairs. Please come back in 15 minutes.